Everybody, and welcome to Tuesday Training. I hope you're having a fantastic week. As always,
we are live from Austin, Texas, right here in Insurance Syndicate headquarters, and man, we have a great show for you.
Good morning. What is happening? Hope you guys are doing fantastic. It's Tuesday, so you know what that means. That means it's a little time for Tuesday Training. We do this every single Tuesday at 9 a.m. having some fun, and we are bringing a special show for you today. Special event. Super excited about this one. I've got two of my good friends that have agreed to come on and duke it out, so to speak, on some of the differences in people's life insurance philosophies of how you sell or how you buy, right? There's a lot of people out there that believe that you should only buy term and invest the rest. And there's a lot of folks that believe like, hey, nah, there's these other advanced market policies in whole life and IUL that definitely have their place. And we've got two gentlemen that are going to basically do a simple but professional debate on those life insurance philosophies. Fairly simple. I'm going to bring them on here in a second. Want to go over a couple of the rules with you guys, though, so you understand what's going on. We are going to bring them on. I've got a bunch of questions that we've curated that we will be asking these gentlemen. Each person will get 3 minutes to answer their question the best of their skill set. They have not been provided questions in advance. All the questions are going to be certainly within their wheelhouse, but they will be answering them extemporaneously. After they get their 3 minutes to answer the question, their partner or counterpart will have 3 minutes to retort. And then we will continue to kind of run through it that way. Couple of other rules. Again, 3 minutes for each person. If you have questions in the audience that you would like us to ask, feel free to drop them in the comments. Can't guarantee you we're going to use it. Depends on the nature of your question, if it's valid, but certainly feel free to drop a question in the comments if you have something ready to go that you're curious about. But with that said, before we kick off, man, this show is brought to you by DFY CRM, my CRM of choice. Definitely one of the greatest ones out there. If you're in the Go High Level package, that is one of the better white labels out there. It's the one I use. And if you're interested in getting a demo, just hit us up. But with that said, without further ado, I want to introduce you to Kaya Conwell with Primerica. He is in corner red, if you will, if you saw the graphic. He believes that you should definitely buy term and invest the rest. And then our other partner here is Mr. Peter Fournier of All Things Insurance Group. Many of you have seen Peter in the group. Tends to be known as one of those guys that kind of believes in the Swiss Army knife concepts of insurance. You need to learn to do all things that are out there, hence the name of his company, All Things Insurance Group. So, gentlemen, you know the rules. You know you get 3 minutes. We know, again, we're going to have some fun. Feel free to talk a little smack, but keep it pro. And, Peter, I would like to lead off with you. Why do you believe that your strategy is the superior choice for building long-term wealth?
So it's not the superior in every case, and this is going to be a tougher debate because I guess we're leaning towards the end-all, be-all. But because of my approach, I don't think it's for everybody. But insurance should be a hedge at the end of the day. It's a hedge against market risk. It's a hedge against the what-if. It's a hedge against sickness, LTC, disability, waiver of premium, etc. So the fact of the matter is, if you're going to put all your eggs in one basket and, shove a square peg in a round hole, it's not going to fit the same for everybody. And the proof is in the pudding. Our largest market in the United States is final expense. Why is that? Because term invest the rest doesn't work for everybody. And that way they're scraping and clawing and coming to us or another agent like yourself, Tony, and begging and pleading for a $10,000, $20,000, $30,000 whole life policy, because at the end of the day, they didn't keep consistent on their investments. They may have panic sold at some point in the market. They may have never listened to an advisor. So I'm not saying it's the end all be all for everybody, but because we see things broken in the BTID experience, That's why final expense occurs. That's why GULs occur later on in life. That's why people are hoping to insure against long-term care, because they didn't do a good job of saving over the course of their life. And that's really plain and simple. We want to attack the market and give the clients every opportunity and present every position to them and allow them to pick. I'm a glorified order taker, and I have been for 15 years. Here's the solution to the problem. Here's the solution to the problem. Here's the solution to the problem. Which one makes the most sense for you?
Fair enough. Fair enough. Mr. Conwell, do you have a retort for that of any sort?
Well, I agree that if a client wasn't disciplined or they didn't talk to a financial advisor early on in life, or before they reach the age of 70 or whatever, they might have to get a final expense plan because, again, they don't have enough money saved just for burial costs. But unfortunately, the policies that are sold to people that can get term still, they're selling whole life policies, the IULs. They're not just for final expenses. They're trying to use them as investment vehicles. So if it's just for a final expense, absolutely, whole life, if they're over the certain age, they can't get term anymore, then that's their only option. Then that is their only option, right? But I'm trying to get to them before that happens so we can plan for the future. And I take a look at their overall investment options and see what they have. Even if they're over 70, they still have investment options that we could do. I think Pete offers annuities. We offer annuities as well, fixed annuities, variable annuities, guarantee the income for the rest of your life. But again, if we're just talking about whole life and final expense, yeah, there is a market just for that. Unfortunately, if they didn't save enough, right? Or they didn't plan ahead for the future, and that's their only option, right? Sometimes that happens, unfortunately.
Understood. Well, I'm going to continue with you, Mr. Conwell. There are some critics of the buy term and invest the rest that would argue that, well, the average person doesn't actually invest the rest. They just buy the term and move on with their life. What would you say to that? How would you maybe better advise those people?
Well, because I have an investment license, I'm actually able to do the buy term invest the difference philosophy. So I don't just sell them a life insurance policy. My job is to teach them how to replace that with actual cash in the future. I'd rather, if it was myself, I'd rather have cash in hand versus paying cash out on an insurance policy that I don't need later on. Because the theory of decreasing responsibility says that as you get older, your responsibilities decrease. For your need for life insurance becomes less and less and less. But at the same time, your investment should be increasing, right? That's where I come in as well, because I have the investment license to do that. So I can teach them how to replace that with actual cash, because you don't need insurance for your whole life. It's only for a period of time until you don't need it, till you're self-insured now when you have cash on hand.
Pete, he said you don't need insurance for your whole life. How do you feel about that?
So, yeah, well, I'm in disbelief of that. One, because I've seen estate tax planning, single premium whole life. For example, we just wrote one the other day, $79,000, one lump sum to get a $225,000 death benefit to ensure that the kids are allowed to pay the estate taxes for like 3 or 4 different properties for the rest of their life. They want to keep this compound in the family. In order to be able to do that and buy term invest the rest, let's say, if you, let's say, what are you guys investing in, Kia? S&P, mutual funds? What are you usually?
Well, it's Kaya, and we invest in all kinds of things. Mutual funds, we have managed accounts, we have annuities, we have an array of products, that can service our clients, not just insurance.
So in this guy's scenario, if he invested the $79,000 in the S&P, let's say it gained 8% a year with no dips, and it was a perfect storm, and at the time of death, the portfolio wasn't completely in the shitter like it was a month ago during tariffs or like it was during 2020, and it was a perfect storm, what would the compounding effect be? He would need, 15, 16 years to be able to compound up to that guaranteed death benefit that gets paid tax-free. And depending on what the funds are, maybe the beneficiaries need to pay taxes on that cumulatively. If it's in a brokerage account, obviously they have the step up, but if it's in an IRA or a managed account, they may have to pay inheritance tax on that. Or furthermore, they have to spend down the IRA after 10 years. So again, my products are just keeping people nimble at the end of the day, because we talked about cash on hand before. I financed my entire office using my whole life policy, about $42,000. I started my IMO with my whole life and my IUL. So in terms of liquidity, yeah, I had some cash on hand and I have a ton of investments, but I'm not going to sell said investments to get 15 or 30% capital gains, or have to pay a penalty on my pre-tax IRA or take from my Roth, because I want those for long-term investments. So what do I go to? I go to the liquidity of my life insurance policies and pay myself back over time.
Kaya, you have 2 minutes to respond if you choose.
Well, I mean, estate taxes, like I think the exemption is 13.9 million right now. Obviously, if somebody has a large estate, that's where whole life insurance can come in to help pay that, right? But in most cases, let's talk about most people, 95% of Americans don't have a net worth of over $14 million, right? So we're talking about average everyday people, middle income families, majority of people in America right now that need real solutions and affordable solutions to them. And yes, we do offer annuities too, Pete. It's not just managed accounts and IRAs and all that stuff, but we have fixed index products, that are non-qualified, just like you do. But we have VAs too that allow them to get more on the market and still have those protections in place. So it's not just it's pure market exposure that they have with all of our investment options or solutions. So again, we got to find the right fit for each client. Like Pete said earlier, he offers a lot of solutions. It's not just cookie cutter type stuff. It's not one size fits all. And we have a lot of those options available to us that we can, find the right fit for a client. So we're not just, putting one peg in one hole, right? We have different size of pegs and different shapes and everything and different holes here that we can, utilize to help a client. So it's not just one size fits all here.
Fair enough. So sticking with you, Mr. Conwell, how does your strategy handle market downturns or economic uncertainty?
Well, because we have a lot of different investment options available, we don't have to just put them all into an aggressive growth mutual fund. That wouldn't be doing my job as a fiduciary if I did that. I've got to put my client's best interest first before my own, first of all. I'm legally bound to that. But again, we got to, we have some bond options. We have stock options, right? We have all kinds of things available to them. So in case it does hedge, we need to hedge, right? If the market goes down, they might have some bonds in their portfolio. Or, we have annuity products too that offer the step ups, just like Pete has those things too, that the guaranteed step ups, guaranteed no loss, guaranteed, no fees in these fixed products. So we have a bunch of different options available. Again, it's not just buy term and invest the difference all in aggressive growth mutual funds. That would be dumb on my part to do that. So,
Pete, how does yours handle economic downturns? Is it better, worse, similar?
Mine keeps you nimble in the long run. And I think about it this way. If you have long-term investments, let's say you're, we know the statistic. You got 10,000 people retiring every single day. And by retiring, I mean aging into Medicare, right? 10,000 people turning 65. So let's say for an entire year during COVID, for instance, or 2008 or 1987 or any of these huge cataclysmic events, right? You're about to retire and you get a 33% market hit, or even later on in life or before. Let's say you had a windfall and you're retiring early and you're pulling 5% out of that managed account to live off of. And we have a 33% downturn like we did during COVID or 08 and across the board, right? It's market Armageddon. Everybody's selling and liquidating. So in that respect, you need about an 85% upswing in order to get back to baseline. Now, if you're just in a managed account or you're just in stocks, or even if you're reallocating funds, you need to hope, pray, beg, plead to get that account back up because you're drawing off of it to live off of. If you started with investing plus an IUL or investing plus a whole life at that time, you could draw some lifetime income or designated 10-year withdrawals, 20-year withdrawals, et cetera, right? Market certain ones on your whole life or IUL to allow that investment to come back. Without it as a buffer, you're kind of SOL. And we see that a lot with our clients nowadays. Like people were running and screaming into our office a month ago because they were losing 25, 30% in their managed portfolio. And even though they have financial advisors, we're not Nostradamus. It's not like, boom, oh my God, we moved you out of this because we saw something happening overseas. Some are really good, but most suck, just like most insurance agents suck, right? So at the end of the day, if we're talking about the average American, we want to be able to keep them nimble so that way they can recover from those economic downturns in the future.
Kai, I'll give you one more minute to add on to that if you choose.
Yeah, which is why we have different options just other than managed accounts and mutual funds for our clients. We have annuities as well, like to manage those downturns. If a client is close to retirement or they get a huge windfall, my job is to figure out, okay, how much money are they going to need? When are they going to need that? And let's put it in the right place. If they need to protect some of that money, well, let's get an annuity, right? Absolutely. Because once you draw the money from a managed account or 401k and IRA, you take all the money out, it's gone, right? But in an annuity, you're guaranteed income the rest of your life. And Pete preaches this too in his fixed products, right? He just said that, guaranteed income for the rest of your life. We have products that do that. So we're not just doing one thing, we can offer everything. But the returns on the whole life policies, if the market, rebounds or whatever, they're capped. You can't even get all of the return of the market. So again, it's just getting fit into one place in an insurance product, but there's other options available to you. So, we offer all of it.
Peter, 1 minute.
Well, not all of it, right? No whole life or IULs. And we do annuities too. But what I'm saying is if we're starting out, let's say I'm 36 years old right now, and I started my IUL, I started my whole life when I was 21. Started my IUL when I was 30. So I'm in the black already on that bad boy. And yes, it's not going to trend the same way with a 30% market upswing like the S&P did maybe, 6 months ago or something like that. But at the same time, it hedges my risk. As I see my portfolios going like this consistently, now my IUL is going like this, or my whole life is like this. And again, from a liquidity standpoint, why would I want to sell my equities in order to pull out money to start a business, to start a side hustle, to buy a house? Yes, some are loan operative, especially in a Roth, but like if I'm in a managed pre-tax account like most Americans are because they believe in that pre-tax, right, mantra, because that's what they were taught in their 401ks and the managed accounts that you guys do, et cetera, we have no liquidity. And most Americans, if we're talking about the populace, don't have more than $2,000 saved in an emergency fund. So if they're running and gunning and watching social media and they're like, holy shit, I want to do what Kaya, Tony, and Pete do for a living, but I got like $500 to my name. Where do they get the liquidity from? The forced savings on the investment side plus the forced savings on the IUL and whole life side are a happy marriage because one gives you liquidity and one gives you long-term, more popular gains.
Kaya, you get that same 1 minute.
Yeah, I mean, again, the wealth building account, long-term tax qualified account is not to be, you're not supposed to take loans from it, and you can, but that's not what it's designed for. It's designed for long-term. Don't touch it till long-term, which is why we offer short-term voluntary accounts that, like a tax-free muni fund that put that in. You have all kinds of stuff, money markets, right? That you can put as much money in and take as much money out without any penalty in a voluntary account. That's what you borrow from. That's what you take from. I don't want to say borrow because there's no charge. There's no policy loan fee to borrow this type of money in those accounts. In an IUL and whole life, there's a loan fee, right? So you're not borrowing your own money here. It's your money. Take it out, put it back in, whatever. But there's certain types of accounts that you can do that with. We're not talking about borrowing from your 401k or your Roth IRA. You shouldn't do that. Okay, you can if you need it, but there's penalties, right? That's why we have voluntary accounts that you can do that with.
Fair enough. Pete, I got a question for you, and I'm glad we're hitting on this, the borrowing and so forth. If I have an IUL and I want to get into my own banker side of that policy, what happens if I borrow 100% of that cash value?
I can't borrow 100% typically. So it's up to 92%, sometimes 90, depending on the carrier. And everything that we're selling and why like some of these people are posting like IULs are a scam and whole life's a scam. Yeah, there's shitty agents out there selling shittier products that are focused on death benefit. What you want in the aspect of a permanent product is non-direct recognition loans. Now, we don't have that much time to get why non-direct versus direct, but essentially you want a collateralized loan from the insurance company. So when I took a loan out against my whole life, ipso facto, it did not come from my cash value. It came from the insurance company. And if I never pay it back, yes, interest accumulates and it comes off my death benefit at the end as long as there's a net positive on that. But in paying it back, my cash was growing at 4% flat. My loan rate at the time was 4% flat. But if I have 100,000 in my cash value and I take out 40,000, I'm being charged 4.5 on the 40,000, which is what, like $1,800 a year, where I'm growing 4,500 still on my cash. So I'm actually arbitraging and increasing my positive payback to myself because my cash is growing. Now, you do have to pay that interest back to the insurance company, where people get all twisted. Oh my God, you're paying to borrow your own money, but you're arbitraging the interest rate. So if you have liquidity in your whole life policy, it is better than going to a bank. It is better than financing an auto loan. I hope one day my Grail car is a Maserati. Hopefully in the next 5 years, I have enough of my whole life policy to finance it myself. Like, that's what you use it for. And you're only structuring let's say a whole life, because IULs, I believe, is for we hope. It's a long-term savings play. But if you're going to habitually use it, you need a non-direct recognition whole life. And it's one of the most powerful tools on the planet if you are going to use it. If you're not, and you're a standard W-2 employee and you have no fucking aspirations of getting rental properties or starting your own business, maybe it's not for you and you need a giant whole life or a giant term policy with living benefits and convertibility options later. But if you think, I'm going to leave this W-2 mentality, or I'm going to start this hot side hustle, or I'm going to open this ice cream store in 2 years, you may want to be your own bank strategy to have that liquidity and essentially pay nothing in interest at the end of the day. Now, you can't guarantee that, right? Depending on the product the agent sells you, they could be a scumbag. But at the end of the day, a well-structured whole life or IUL is a powerful tool.
Mr. Conwell.
Non-direct recognition whole life. Who the standard consumer, who does even understands what that means? Are you kidding me? Crazy. But first of all, paying someone else to borrow your own money, there's a fee to do that. Okay, it could be a wash if you get the return, but the return is also wash or almost wash, right? Because yes, if the fee is not 4%, they're like 6 or 8% to borrow from these things, and your return is 4%, 6%. Okay, you're getting a return on the higher number, but you're reducing the return because of the loan interest. You're not getting all that 6% credit to your account, and net, it's only like 2 or 3%. So a long-term wealth building strategy, when you're only earning 2 or 3% after you take out these loans, that doesn't sound very good to me. Even if you don't take out a loan, because of the caps, the performance caps on these things, you're not even getting the full return of the market. If the market's been returning 10, 11, 12% the last 20, 25 years on the average, you're not ever going to see that in a whole life policy or an IUL. You're just not going to do that because of the market, the caps that they have, the performance caps. So again, but if you had $50,000, just put it in a voluntary account, earning some dang interest for you. And if you want to take it out, you can take it out without having to pay it back. No loan on the dang thing. You don't have to worry about taking out too much because again, they cap you at, they said 92%. Most policies are 80%. You can't even borrow all 100% of your money anyway if you need it, if you have an emergency. Because if you do, the policy will lapse. Why tie those two things together? Why risk one with the other?
Peter?
So I think we're getting like IULs and whole life conflicted. The whole life steady, right? You get, let's say, a 4% fixed rate or whatever the case may be. So in that non-direct recognition situation, and I understand the consumers don't understand it. That's why I still have a job for the last 15 years, right? It's your job to explain the difference between direct recognition and non-direct recognition loans and what the goal is for the client. If they want to buy a Ferrari for a midlife crisis 15 years from now, we can structure that so that way they can borrow their own money. But again, you're arbitraging in a whole life. So if you got 100K growing at 4.5 and you're borrowing 40 at 4.5, you're winning. Now, if I have that money in a managed account or something of that nature, and I think of my own liquidity, I believe in crypto. I flip watches every now and again, right? I buy gold. I have a diversified investment portfolio, but I'm not going to sell my gold to build office furniture. I'm not going to sell my crypto. I'm not going to sell my stock in Apple, Tesla, etc. Yeah, I have a money market account that some of my commissions come into and I gain 3 or 4%, but that's your cash liquidity. I've been saving in some of these products since I was 21, 22 years old. So I got a considerable amount of money in there. So why not borrow from that, net zero on the borrowing and pay myself back? You got to pay a little interest to the insurance carrier. But again, simple math, If I have 100,000, I'm making $4,500 a year off of it, and I borrow 40 G's and it costs me $1,800. I'm still net positive, and I didn't fuck up any of my future investment portfolios. Again, it's just to keep you nimble. It's not going to be for the $52,000 a year average earner, but if you're making six figures and your goal is to start a business one day, you may want it. I also funded an IUL for myself and for my daughter for a long-term we hope strategy. Again, it's just a hedge. If my investments are in the shitter when I turn 55, 60 years old, and I don't want to draw off it because I feel like I'm shooting myself in the foot, well, I'm just going to draw a consistent income off of my IUL or my whole life for myself, or knock on wood, my daughter's, if she's still alive, and have time to rebound. Now, if I'm at all-time market highs, I may still want this product too, because I don't want to destroy what's going on in terms of my long-term growth. So I'm going to take the liquidity from that.
Kaya, I'll give you another opportunity to respond there.
Fees. And you talking about whole life or IUL, you have even more fees than whole life. As your premium that passes every door of the insurance company, it's another fee. And these take out from your return too. So your potential earnings is a lot lower because of all the crazy fees that are in these things. So rule number one, never pay someone else to borrow your own money. It doesn't make any sense. To me, as a consumer, why would I want to pay 6% loan interest to a bank to borrow my own money if I pull money out of my account? It doesn't make any sense to do that. It never does. It's my money. I don't have to pay it back. And if I don't pay it back in these policies, there's interest that's accruing, right? There's fees and penalties and everything else. And then if I die and I have a loan, that's a whole nother issue that can happen there. It's insane. I would just never do that.
So I'm going to give you a chance to retort, Pete, but I want to say this. Or he's talking about obviously fees, paying the interest to get your own money. Are the fees really that problematic? Is it just a matter of structuring the policy properly so that the fees return to the bank, the percentage that you're paying when you borrow your own money, and I don't know, commissions maybe, don't negate the value that the policy has?
Yeah, on the IUL side, you're definitely going to have some premium load fees. You're going to have administrative fees. And a lot of that is eaten up usually in the first 3 to 4 years. So anytime we're selling this to a prospect, it's basically like, dude, on the IUL side, this is a we hope. Just like we don't know what the market's going to do. And if you get into a managed account, I can't promise that you're going to get slapped in the face with a 30% negative return next month. Same thing on the IUL, except we can kind of set our watch to it because the fees are outlined. So by year 5, year 6, depending on your age, and I wouldn't sell an IUL below probably 45 years old or above 45 years old for accumulation value, the fees are disclosed. Now on the whole life side, a lot of them don't have any besides the cost of insurance. We're usually adding a giant ass term policy as a rider for 10 to 20 years. So that way we could stick more money in the cash bucket so it doesn't mech out. So now you're getting the best of both worlds on the steady returns of, let's say, 4.5% consistently. Plus you have your term rider attached, and that eventually falls off, giving you just the whole life later. That plus the paid up additions, the insurance keeps growing and the cash keeps growing. But in terms of fees, like borrowing your own money, should we get rid of HELOCs as a nation? I mean, you're paying a fee to borrow your own money on a HELOC. It's the same thing. And people do that all day long to put on a deck or some bullshit in their house rather than start a business. So instead of going to the HELOC, and right now I have one out on a property so I can buy another property, I'm paying 6.9%. If I had 250 grand sitting in my whole life policy, I would have borrowed from that because it would have cost me nothing at the end of the day. That interest arbitrage would have beat it. So I'm a fucking idiot and I should have funded it more ahead of time. But again, hindsight's 2020. We can't predict the future or what goals we're going to have later on in life, which is why you should have a whole life and an IUL also with an investment account.
Kaya, you got a minute left if you want to hit that some more.
Well, if you do a HELOC, you're not borrowing your own money, you're borrowing the bank's money because they're giving you some of the equity of your property up front. Right. And they're funding that. So it's not your money that you're borrowing. That's why you're paying them interest. But in the IUL, it is your money that you're borrowing and you're paying them interest. Because really at the end of the day, if you die and there's a loan outstanding, that reduces your death benefit, correct?
Sure.
Right. Okay. So why would you want to have those two things tied together if one affects the other? It doesn't. it's something that you got to watch like constantly. Am I paying enough in my premium to kick the can down the road long enough that this policy is going to stay in force and doesn't lapse early, right? There's so much stuff going on with these policies that you have to constantly be on the lookout for, the returns, the fees, the loans, the interest, all of that. Just simplify the thing. Get term insurance, which is pure insurance. You pay, you die, we pay. There's no loan that you have to take against it because there's no cash value. It's just pure protection. And then get an investment. Get an annuity too if you need to do that, to have, to hedge or whatever. Get bond funds, all of those things. But again, you're not paying to borrow your own money when you do a HELOC. It's the bank's money.
Can we touch on the equity in the policies too, Tony? Do we have time?
Yep, we do have time. Go ahead.
Just want to give you an example of whole life that's near and dear to me. So my grandfather, granted he was born in 1927, he's passed now, paid $190 a year for $20,000 of coverage when he was 30, right? 1949, I think. He got the policy. He got permanently disabled when he was 47. So dude paid in like, what, $3,200 to get a $20K death benefit? Like we harp on the borrowing and the accumulation and stuff, but like, term invest the rest. Why have a fucking house? Why not rent your property and just invest the rest with you guys constantly? The equity that you're building up in these products are just not for borrowing. It's to keep you nimble on reduced paid up, to eliminate future fees, or to maybe, God forbid, you get a debilitating disease like ALS, cancer, something of that nature, and you don't have to pay for the product anymore. So hence the arbitrage is actually cheaper than buying a term policy in some situations.
Kaya?
How much was his premium?
It was $190 per year.
For $20,000 of coverage?
Mm-hmm.
That agent did him a disservice. He could have got way more coverage for that same money, or just got term policy for $20-$30 a month for $20,000 of coverage, invested the rest. He would have had more. Then, it's like, are you kidding me here? $20,000 paying $190 a month for it? Who sold that to him?
Per year.
Per year? Okay, what is that per month? $12, $15, $16?
$18, somewhere in there.
You could have got more coverage. He could have got double or triple the coverage for that same premium when he was in his 20s. That $20,000, that doesn't do anything for a family.
It does in 1949.
Well, he would have got 50 or 60,000 in 1949, which would have gone a lot further than 20,000. Agreed?
Yeah, and they didn't have waiver of premium and disability riders on term back then. They used the equity in the policy to alleviate that. So if you had a term policy, it would have expired post disability, and then he would have been fucked. But instead, he put in $3,000 and got out 20.
Well, I'm glad that term doesn't work that way anymore. Right? They have those terminal illness benefit riders and guaranteed renewable clauses in there. Like ours is guaranteed renewable till age 95 if you do need insurance till your whole life, right? But ours doesn't expire. But yeah, back then he could have got a lot more coverage. I mean, that's wow. Anyway, if I was to sell to somebody for $190 a month premium, hopefully they're gonna get $500,000 or $600,000 of coverage
per year
versus yeah, even for a 20-year-old, $190, that's gonna buy him a couple $100,000. Whole life policy is not gonna give him that for sure. So.
Moving in, leading in with the equity thought process for a second. Pete, I'm going to come back to you. In an IUL, what would be my cash surrender value at the end of policy year 1 if I were to only pay a monthly premium and not front load it with a bunch of cash?
Oh, God, probably zero. If you have an option level A death benefit, remember, IULs is a glorified annual renewable term, right, with a cash component to it. So if you're just funding it at target, and again, this is where the debate comes into play, like, oh, these guys are just selling shit for comp. If you sell it like shit, you sell it for comp. Like if I sell a $10,000 a month IUL, I make like $2 or $3 grand. Like it's nothing crazy, right? Or no, 10,000 a month, I make 20 or 30 grand based on target, but it's nothing crazy. You're not getting the whole comp on the premium. So if you're on level A and you're just buying cost of insurance or just target, you're probably not going to have any surrender value in year 1, 2, maybe 3. You'll have a little bit. It basically escalates like a final expense policy. You don't like to see it. If we're doing it the right way, you should have probably, I would say, between 85 and 90% year one, depending on the carrier that you're using, obviously. And then we always back up in the case of an IUL, because the death benefit's so low, we always back it up with a term. And we do that for a couple different reasons. One, for obviously escalated death benefit, but two, for living benefits. Like I have a buddy with an IUL that he funds at $1,000 a month. He also had $1 million term. Dude had a heart attack on the flag football field at 37 years old. So he got a $500,000 living benefit claim from the $1 million term. And then he's able to keep his IUL because now he's uninsurable, at least for about 10 years. So he leveraged the money, infused that into his business, kept the IUL going for long-term repair, and then he's off to the races. Glad he survived. But yeah, if you're just structuring it on minimum death, which you're a scumbag, or a target premium, unless you're doing it for death benefit purposes, you're not going to have much cash year one. The only time you do level A is like if you want a GUL scenario, which we can get into details later if we have time.
Kaya, your response?
So, right, the key thing you said is zero. Like, where did the money go? If you're paying $1,000 a month premium, which I had a client that I replaced her policy, IUL, she was paid $1,000 a month. After year one, after year two, her cash surrender was zero. So she put in 24 grand into this policy, and it was sold to her as an investment, by the way, not an insurance policy, because they are insurance policies, they're not investments. Let's get that let's all understand that. On page one, it says this is an insurance policy, not an investment. So 24,000 that she put in after 2 years, and she had $0 if she wanted to pull it out. What kind of investment is that? What he keeps saying after year 5 or 6 is when you really want to start utilizing this. What about the first 4 years? What about that? What about the cash in that? It's because of surrender fees. The surrender schedules on these things are from 5 to 20 years, depending on the product and the company. So even if you wanted all your money, you're like, you know what? I'm just going to walk away. I saw some returns in there. I'm going to take it out. Whoa, hold on. You can't take it all out because of surrender fees. What are you talking about, surrender fees? Well, I put in like 30 grand. I only have 10 that I can take out. Yeah, surrender fees, right? And again, if you want to borrow it in the first couple of years, you can borrow some of it, but you can't even borrow all of it. Even 50 years into the policy, you still can't borrow 100% of your cash. So if you have an emergency and you just need to liquidate that thing, you're going to have the policy is going to terminate, right? It's going to go away when you have no more cash value. Is that right?
Yes. Mm-hmm.
Okay. So if you have an emergency, just make sure you only have 92% of an emergency, right? That you need money for.
Peter?
What's the largest investment in America right now? It's 401k. What's the cap on a loan rate of a 401k? Because that's everybody's liquidity. That's all you got. 50 grand. That's all you can borrow. That's it. And most companies are not offering Roth 401. I know the argument. Well, if it's Roth, most companies don't offer that. So you have a pre-tax 401k with absolutely no liquidity. And if you cash it out, not only are there penalties, but the IRS comes knocking on your door. So yeah, everything comes with a give and take. But I'd rather $92,000 of liquidity out of my 100K than $50,000 when I got 450 grand sitting in a pre-tax 401k, and all I see is it going down and down and down. Oh, and what's this 1.25% management fee? And what's this money market account that's paying me no money, but I'm being charged a management fee on it? Like, there are these situations with every product. Yeah, that sucks for your client, and the person that sold it to them are scumbags. But at the end of the day, if she had option B at $2,000 a month, she'd have a shit ton of cash value in year 1 or 2. So it depends on what the goals of the client actually are. If we know you're going to set it and forget it, and we're going to reallocate these indexes, right, every year or 2 years, et cetera, and you're not going to touch it, then IUL is the play, because that's a we hope, right? You're going to do it with $250, $500, $1,000, $5,000 a month. My bare minimum is $250. Anything lower than that, you're not circumventing the cost of insurance, and it doesn't make sense. If you're going to use loans habitually, then you use whole life, because you can set your watch pretty much to the interest rate. You have that non-direct recognition, even though some IULs do, and you can use it, fund the office, fund an apartment complex, etc. But different strokes for different folks just in the permanent product sector. Similarly, we're talking about equity. If you have level A, and again, people don't remember what they had for breakfast the other day. So she could have been sold on, hey, you'll have this death benefit forever, and it's cheaper than whole life. That's not a lie, because it could have been structured as a GUL perspective, and that $2,000 a month gets her $1 million of insurance coverage until age 121 with a level premium. We sell GULs all day long because at the end of the day, it's cheaper than a compounding term effect, right? I don't have escalations in my premium. So if I keep my premium flat, let's say 50 years old, I need $500,000. Instead of buying a 20-year term and a 20-year term and a 10-year term, I'm going to have this flat arbitration of GUL. And now you don't have to play the game of like, oh, I'm going to bet on the don't pass line on fucking craps, and I hope I die early, versus positivity of dying later.
I like the pass line, by the way. Nobody likes that. That dude that rolls up at the craps table and bets the don't pass, nobody likes that guy.
Nobody likes that person. Yeah.
Kaya, I'm going to give you another opportunity to respond to that.
Well, he keeps trying to pigeonhole me into qualified accounts. That's not all we do. Again, qualified accounts aren't designed to just start taking loans out and borrowing your money or whatever. They're designed for long-term wealth. If you have to have money and you're in an emergency and that's all you have, okay, you got to take that. Okay, but again, there are other options available to you, like voluntary accounts, money markets without management fees, without expense costs, that you can put as much money as you want. Tax-free municipal bond funds that are federal tax-free. In some states, they're state income tax-free too, if the bond originated in that state. There's a lot of different options to you to get money. If somebody has $50,000 up front, just stick it in a money market or stick it somewhere in a tax-free muni fund where you don't get charged all these crazy fees and lose some of your money, a percentage of your money up front because of the fees and the commissions in an IUL or a whole life policy. Get all that money working for you right away. But in those policies, you don't. And again, after year one, you don't even have access to all $50,000 that you put in there. It's just, right? It's just, you don't because of the fees and the surrender charges. So, there's other options out there. I just don't do one thing. I have an investment license. I can do a plethora of things for my clients.
Peter, I have $50,000 liquid. I've been trying to figure out something to do with it. What should I just put it in a money market account?
Start an insurance business? No. 50K liquid. See, the lump sum conversation is tough. And it's funny, like I just sold a 43-year-old literally last night, a $31,000 FIA, and came to me for it. And it was more so that I had a dormant IRA. Now I have a business. I can't touch that money till 59 and a half. And I really don't want to see it go up, down, or fucking sideways or in fucking circles based on the market. So I want to fund my business. My best reinvestment strategy is in my business. And I'm not going to worry about Apple and Chipotle and all this stuff to make me my money. In that situation, maybe it makes sense to get an FIA at your age. 50K, it depends on what the strategy is. Do you want long-term consistent growth without any going backwards? Do you want to leave that money behind? Because Tony, just guesstimating your age right now, even though I know, 50K might get you $112,000, $113,000 of single premium whole life for the rest of your life. And arguably, it would take a very long time with never going backwards to get that 50K to 112, right? It's a rule of 72. So depending on the consistent interest rate, that's when it will double. So if you want to leave it behind your beneficiaries, do that. If you have no idea, start a side hustle.
Kaya?
Yeah, it's all dependent. It's all client dependent, right? That's why we got to, do a risk profile questionnaire with our clients and figure out what their goal is with that money. And since I have so many different options, there's so many things on the table. FIA, okay, if that's what they need, they just they want to see, no loss with little to no fees in there and just minimal growth. And there's guaranteed step ups, but that's on the income side of the annuity, not the account value. And again, with caps that are on annuities, performance caps, you're not going to get a big return on that. If that's what you're expecting, just like 2, 3, 4% a year on those things, okay, FIA, right? But if you want to see potential more growth long-term, 20, 30 years down the road, maybe an FIA is not the best fit. Maybe a variable annuity, maybe a managed account, maybe an IRA, maybe, Roth, maybe a mixture of all those things, okay? Not just an insurance product. So again, it would just depend on what you want to do with that money and what your end goal is.
Perfect. Which leads us to an excellent question to get towards the wrap up for this show. How do you, and I'm starting with you, Kaya, and we'll get to you, Pete, next. Kaya, how do you determine how much coverage your client or prospect actually needs?
Perfect question. We do what's called a DIME analysis, D-I-M-E. D stands for debt. Mr. and Miss Client, do you want your debt paid for if something happens to either one of you? Okay, yes. What is the cars and credit cards? Let's say it's 50,000. Cool, we'll put that number in there. M stands for mortgage. Would you want the balance of your mortgage paid off if something happened to you? Yes. So it's 300,000. E stands for education. If you have a couple kids, you want their college taken care of for you, or for them, or do you want them to get, hopefully get scholarships, right? Most people go, no, I'd want to pay for their college if something happened to me early, right? Okay, so we factor that in, and how much that is. The I is the biggest one. That's the income replacement, because the whole purpose of life insurance is to replace your loss of income. That's it. That's the only reason. So if you were bringing home $7,000 a month and you pass away, then that $7,000 a month is gone, right? And whatever in the 401ks, goes to your beneficiary, whatever. But we got to make sure that $7,000 a month keeps coming in for that family. Okay, I'll ask the spouse, how much would you need if the bills are paid for, right? The debt's gone, the mortgage is gone, you still got the living expenses, all that. How much would you need coming in on a monthly basis to make sure your standard of living doesn't change for you and the kids, or just for you if they don't have any kids? And they give me a number. That's like 2,000, 3,000, 4,000. Well, I want all 7,000. Okay, let's say 7,000 times 12 times however many years they would like that for. And then we add all those numbers together. And that determines what kind of coverage they need right now. And you need probably 10 to 12 times your income for life insurance coverage, especially if you have kids, because you got to replace that income. We can't replace the person, but we can at least replace the income that they're bringing to the family. And that's the only purpose of life insurance, is to make sure whoever you leave behind, their standard of living doesn't change. Maybe it gets a little better, but definitely we don't want it to get worse, right? That's why. And so term insurance gives you the most bang for your buck. You can get the right amount of coverage that you need, whether that's $1 million or whatever, that's affordable for that family, not $1,000 a month or maybe a couple $100 a month for the same coverage. So that's how we calculate what they need right now.
Pete, same question. How do you determine how much coverage your prospect or client actually needs?
I like DIME. That's like 15 years ago from my Northwestern Mutual days. I got like PTSD. So that's good that you guys do that. Debts, minimum in terms of term length of time is you want to get the kids post-graduation. At least that's my rule of thumb. So if you got a 2-year-old, you want to get them to 20-year term, right? And you always go by the youngest. Then it's about 5 to 7 times your worth of your income. So I would say the culmination altogether is about 10, 12x based on affordability. I also go after, if they have young kids, I firmly believe, and I've believed this for about 12 years now, and thank God for ChatGPT, because I'm right. If every child had a $250,000 whole life that was paid up in 10 or 20 years, we would be out of poverty in 81.5 years. You can ChatGPT it, have it do the math. And I thought it would take 2 to 3 generations. If everybody bought a whole life that lasted forever, that was paid up early on, we would not have poor people anymore. Have people with bad decisions, and we'd have to negate some of those. But if they parlay it into an income or an investment product later on, when that person passes, we're out of debt. We're out of poverty. We got no more poor people. So I go after a $250,000 whole life policy that's paid up in 20 years if they can afford it, 10 years if they can really afford it on each kid. This will guarantee they have insurance for life. The average policy is going to cost somebody about $100 a month. So over the course of 20 years, you're paying $24,000 to give the kid $250,000 worth of coverage with a GIO, which allows them to purchase up to double, depending on the carrier, over the course of their life up to age 40. So they can get up to $500,000 later at the insurability interest of a 0-year-old or a 2-year-old. And if they can't do that, we step it back. Because if every child got a $100,000 whole life policy when they were born, there's about 3.9 million kids born each year. Even at 100K, 2 generations, no more poor people.
Kaya, do you have a response to that?
Yeah, Pete keeps using the word afford, if they can afford it. The reason why, because whole life premiums are 4 or 5 times higher than a term policy or more. Why, again, so why would you get $250,000 on a child? They're not making any income for you. That's for loss of income. Obviously, for funeral costs or whatever, you shouldn't need any more than $50,000 on a child, unless they're a child star, right? They're making money for you somehow. But gosh, $250,000, that's a overkill, no pun intended. But if it's $100 a month, okay, let's say that's the premium for $250,000 on a 2-year-old. Get a child term writer on your policy. They're covered on your policy till age 25 with us, and at 25 they get 5 times the coverage, qualified, guaranteed, than what they had under their parents' policy. So they have 50,000, they'll get 250 guaranteed. They just pay the premium or whatever their age is at that point. Could be $19 a month or whatever. And invest the difference put it in a 529 plan for their college, or if you don't think they're going to go to college, put it in a mutual fund account for them, something that's going to grow more than sitting in a whole life policy with low returns and fees, with all those fees that are associated with it. It doesn't make any sense to do that. $100 a month per kid, you can get your money working for you better than just buying a whole life policy.
Pete, you got 1 minute.
Affordability, what's cheaper, renting or owning?
Well, it depends on what market you're in. But if you own something, you could get equity, right? But why would you want to own an insurance policy? Because I know where you're going with that. Insurance is only for a term of time until you don't need it, until you're self-insured.
Now, because what if that kid wants a car for college, or doesn't want to go to college and wants to cash out this sucker because the cash accumulation equates to the policy premium in year 19 or 18 or 17 on a 0-year-old. So I've never lost money on a house, right? I've lost money burying it in rentals, but I had to at that time because that was the more affordable option for me. But owning my property, I never lost because you have the equity buildup. So again, different strokes for different folks. If you listen to Grant Cardone, you should rent the shit out of your lifestyle for the rest of your life and then invest the difference into his REITs or the stocks or bonds or whatever. If you listen to other people, you should own 50,000 homes. Point being is the average American consumer should have the option to weigh both.
Kyle, I'll give you 1 more minute.
Yes, and an agent, I'm not just an insurance agent, I'm a fiduciary as well, should be able to lay out the differences between A and B to the client and let them make up their own mind which is best for their family, right? Do you want to sell them a high commission product, which most insurance agents are doing right now?
That's less commission term, but yeah.
So if it's right, so $100 a month on a policy that's $250,000 versus $12 a month, I'm going to make less on the $12 a month than I am on the 100, right? But what's better for their family? What's better for their pocketbook? Obviously, the $12 a month versus $100. It doesn't make any financial sense. If I can sell them the same coverage for less money, that's what's better for the family. I don't care about my own pocketbook. I'm going to get paid, of course, but I'm getting paid on a lesser amount, and I'm fine with that because that's better for the family, especially long term. And I can show them how to, make money, long term, because my clients are my clients for life, 20, 30 years down the road. When you don't need insurance, you'd rather have cash because you can't pay groceries with insurance policies. You have to have cash to do that. And I don't want to take a loan against my life insurance policy just to put food on my table, right? So that's why we have other accounts.
One final question to wrap this up. This is a little bit of a bizarre question, so please listen closely. If your opponent's strategy did not exist, what is one element of that strategy that you'd actually want to borrow and integrate into the way that you present life insurance? Pete, I'll start with you.
If their strategy didn't exist, what's one portion of the strategy that I would incorporate into pitching?
Correct. And in how you show life insurance. Like I said, it's a little bit of a weird question.
Well,
in other words, what do you like about his strategy that you would steal from?
My mantra is universally, almost everybody in the country should have a term. And I mean that during your working years, right? Because it is the cheapest form during that time. But you should also have a term based on living benefits. And I mean chronic, critical, terminal, chronic injury, all the good stuff, not just terminal illness. Because you have a 55% chance of getting diagnosed with cancer, heart attack, stroke, a lot of the triggers before the age of 65, before you ultimately die, right? Only a 2% term policy pays out during your working years. But that would be the incorporation of the strategy, is like everybody who's bringing home income should insure said income for sure.
I heard you say something. I know you didn't say it this way, but I know what I heard. Until you get to age 65 where you ultimately die. And I was like, damn. I'm counting. Kaya, what is one strategy that you would take from Pete's philosophy in life insurance and adapt to your own?
That's a really tough one because I know a lot about those policies and how they work. We do adopt some of those things, like protecting the investments or the money, right? We have the annuities and things like that. So we already have strategies that these policies offer, like the IULs, like the protection of your cash and things like that. So we already have those strategies already in place for our clients. It's really hard. I couldn't really, other than what we do already, like protecting income and all that they do inside these IULs. They protect the cash. That's what we already have used that strategy for our clients. I like that strategy.
Understood. Fair enough. Well, gentlemen, I certainly appreciate you taking time out of your own busy days. I will tell you that the comments in our video have been blowing up. It's definitely one of the most popular and highly engaged videos that we've done in the Insurance Syndicate. Everybody loves it. So I'm going to leave you with this. If someone would like to reach out to you, Kaya, and chat with you more, what's the best way to locate you?
They can do email or cell phone. My email is kayaconwell@primerica.com.
Easy enough.
Cell 512-626-7950. Yeah, pretty easy guy to reach.
Mr. Fournier?
At Peter J. Fournier, literally everywhere on social. Just hit me up.
Easy to find. Well, thank you again, gentlemen. Thank you guys for tuning in. We are going to work to continue to build similar content like this. If you have some questions that you think we should be addressing, put them in the comments, make a post, let us know what you're looking for. Until then, we'll see you next week for Tuesday training. Have a great week.
Thanks, Pete. Thanks, Tony.